Coming to the second chapter, which is Introduction to Securities Markets. So the market in which the securities are issued, purchased by the investors, subsequently transferred, is called the securities market. It's broadly shares, stocks, bonds, debentures, etc., etc. Derivatives is also part of securities market, mutual funds and government securities. Now, primary market terms. So you have something known as the public issue, where initially, whenever any stock or any script is available first time for retail investors as a fresh offer, that's known as a public issue. Then you have the IPO, which is the initial public offering. That is the first time when it is issued to the public. Then you have the FPO, which is further public offering. So here basically what happens is that when already a listed company makes either a fresh issue of securities to the public, it is called further public offer or FPO. When a company wants to add additional capital for growth or distress, sorry, to redo its capital structure by retiring debt, raising capital through fresh issue of capital in the to the public, this is known as the FPO or the further public offering. Rights issues are there. So people who have already been a part of or are holding a particular stock, they are given the rights issue. Then we have private placements. So private placements is whenever an issuer typically makes an issue of securities to a selected group of persons, which is neither the rights issue nor the public issue. It is called private placements. Okay. It is primarily a wholesale issue of securities to institutional investors. This could be also in the format of QIPs, which is qualified institutional placements, or preferential allotment. Coming to the preferential issue. Preferential issue is when a listed issuer issues securities or shares or convertible securities to a particular group of people. The issuer is required to comply with various provisions defined by SEBI relating to pricing. Disclosures, etc., are to be there. When we look at QIPs or qualified institution placements, it is a private placement of shares made by listed company to certain identified categories of investors known as qualified institutional buyers or QIBs. QIBs include financial institutions, mutual funds, and banks, among others. Next, we look at bonus issues. So bonus issues are issues of shares made to existing shareholders of a company without any consideration for them. So when I issue a bonus, I don't ask my existing investor to pay me anything. It's simple, right? I'm giving something which is free of cost. It is an entitlement to bonus shares depending upon the existing shareholders' holding of that particular equity. A bonus issue in the ratio 1:3 means that the shareholder is entitled for one bonus share for every 3 shares which he or she holds. Then you have something which is known as onshore and offshore offerings. Obviously, onshore will be when you're raising capital in-house, so in the domestic market typically. And when you're raising capital outside the domestic market, it is known as offshore. Coming to OFS or offer for sale. An offer for sale is a form of share sale where shares are offered in an IPO or FPO and are not fresh shares issued by the company, but an offer by existing shareholders to sell shares that have already been allotted to them. So here in your IPO or FPO, the company, the manufacturer are actually giving out the shares. Here it is not that way. Existing shareholders are selling the shares and they are bought by new shareholders. And OFS does not result in increase in the share capital because the shares are just merely transferred. There is no issue of fresh shares. The proceeds from the offer go to the offerers, who may be the promoters or the larger investors. It may be stated that OFS is in secondary market transaction done through the primary market route. So it's actually a secondary market, but done through the primary route. Then we have ESOPs. So ESOPs, some companies offer employee stock ownership options that enable employees to own a small stake in the company, in the share capital of the company, as there are no incentives to participate in making the business. So there are incentives to participate to make the business more efficient and successful. So there's a vesting date involved in that, which indicates a date from which the shares, the ESOPs get converted. Coming to the FCCBs, which is the foreign currency convertible bonds. So foreign currency convertible bonds denominated debt raised by it's usually the debt raised by companies in the international markets, but which have the option of converting into equity shares of the company before they mature. So that's a convertible bond in the sense. Then you have the ADRs and the GDRs, depository receipts as we call them. So ADR is American depository receipts and GDR is obviously the global depository receipts. The DRs or the depository receipts are financial instruments that represent shares of a local company but are listed and traded on a stock exchange outside the country. DRs are issued in foreign currencies, usually dollars. To issue a DR, specific quantity of the underlying equity shares of a company is lodged with the custodian bank, which authorizes the depository receipt issues. So this is about the depository receipts. Last in this list is the anchor investors. In 2009, SEBI introduced the concept of anchor investors in public issues. The volume and the value of anchor subscriptions serve as an indicator of the firm's soundness of the offer. Anchor investors means qualified institutional buyers who make the application for a value of 10 crore rupees or more in a public issue. Coming to market participants and their activities. So if you have to look at market participants, you have the stock exchanges, the BSE and the NSE. Then you have the depositories. Then you have the depository participants or the DPs as we call them. Then you have the trading members, the stockbrokers. Then you have authorized persons which are there. Then you have the custodians. You have the clearing corporation. You have clearing banks. You have merchant banks. And finally, you have the underwriters. I'll quickly take some of them and explain what it is. Coming to the depositories, depositories are institutions that hold securities, shares, debentures, bonds, government securities, mutual fund units, etc., of the investors in an electronic form. Investors open a demat account with the depository. Currently, there are two depositories that are registered with SEBI, the CDSL or the Central Depository Services Limited, and the NSDL or the National Securities Depository Limited. Coming to the depository participants or the DPs, it is an agent of the depository through which it interfaces with the investors and provides depository services. Investor level accounts in securities are held and maintained by the DP, and the company level accounts of the securities are issued, or the securities which are issued is held and maintained by the depository. So that is about the DP. Coming to the trading members and the stockbrokers, we understand that authorized person is actually an agent of the broker. It was earlier referred to as sub-broker and is registered with the respective stock exchanges. Custodians is an entity that is vested with the responsibility of holding funds and securities with its clients. Coming to the clearing corporation, the clearing corporation plays an important role in safeguarding the interests of the investors in the securities market. Actually, it offers a counterparty safety to the investors. The clearing agencies ensure that members of the stock exchange meet their obligations to deliver funds or securities. These agencies act as a legal counterparty to all trades and guarantee settlement of all transactions on the stock exchanges. Coming to the clearing banks, clearing bank acts as an important intermediary between the clearing members and the clearing corporation. Who are merchant bankers? Merchant bankers are entities registered with the SEBI and act as issue managers, investment bankers, or lead managers. They help the issuer across the security markets with issuance of securities. They are a single point of contact for the issuers during issue of new securities. They will evaluate the capital needs of the issuer, structure an appropriate instrument, get involved in the pricing and of the instrument, and manage the entire issue process until the actual securities are issued and listed on the stock exchange. They also engage and coordinate with other intermediaries such as registrars, brokers, bankers, underwriters, credit agencies, etc. in managing the issue process. Coming to the last part of this slide, underwriters. Underwriters are intermediaries in the primary market who undertake to subscribe any portion of a public offer or securities which may not have been bought by the investors. They serve as an important function in the primary market, providing the issuer comfort that if the securities being offered to the public do not elicit the desired demand from the investors, they underwrite, they will step in and buy the entire securities.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.